Consider this. The 10-year potential return for the stock market is better now than it was at the end of 2019. Interestingly, it has nothing to do with how fast a coronavirus vaccine is developed or with the shape of the economic recovery. So, what could be the greatest predictor of future stock market returns? Well, let's take a look. According to a study by Mark Hulbert of MarketWatch, the improved outlook for the stock market is due to the reduction in the share of households' financial assets that are invested in stocks. It turns out that household equity allocation is a contrarian indicator, which means that household equity allocations is inversely correlated with the stock market's return over the subsequent 10 years. Household equity allocation is a flip side of the coin from household cash. You will hear in the media about cash on the sideline, and you may have noticed or heard that higher cash levels are therefore bullish. In other words, higher cash levels represent potential for the market. The money is not invested and can flow to the markets and lift prices. Currently, cash allocations have risen substantially with the recent fall in the stock market. Backtesting has shown that household equity allocation is a very good predictor of the market return. According to Ned Davis research, the level of household equity is able to explain 77% of the variation in the stock market's return in all 10-year periods since 1951. At the end of 2019, the household equity allocation was about 56%. This was a level that was close to the peak set at the market tops in both 2000 and 2007. You can see the cash levels in this chart as shown by the red line. You can also see how the cash level generally moves in an opposite direction of the annualized return of the subsequent 10-year period as shown by the blue line. So, this is why that at the beginning of the year, even before the coronavirus was in the picture, the stock market's 10-year outlook was not good. Based on the year-end 2019 household equity allocation level, the model constructed by Mark Hulbert projected a 10-year inflation-adjusted return of negative 1.3% annualized. Note that this is not a short-term market timing tool as the data are updated only quarterly by the Federal Reserve and with a significant lag time. First quarter 2020 data was just released. It showed that the household equity allocation at the end of March was about 49%. According to Hulbert's economic model, that level translated into a projected real 10-year return of 2.3% annualized from the March 31st level. However, the stock market rallied strongly since then, which of course reduced the 10-year return projection. But even with this recent rally, the model is still projecting an inflation-adjusted total return for the S&P 500 of 0.5% between now and the end of the first quarter of 2030. At least this is better than the negative 1.3% annualized 10-year return that was projected at the end of 2019. The projected return is far from exciting. However, this seems much more plausible than the doom and gloom peddled in the media lately. And with a positive market, one should be able to find stocks that have a tailwind that may exceed these projected returns. And it's better than bonds by far. And for today, that's ChewDog Charts. Thank you.